A new batch of critical macro U.S. economic data has landed. Let's get the read on it now from our chief equity strategist and economist, John Blank. John, what do you see the Fed doing on tightening in light of the favorable CPI numbers?
Well, Terry, in July, it's almost certain they're going to give us a 25% basis point hike. And then we have the August break for the Jackson Hole event. We'll hear Powell speak at the event, but not lay out any monetary policy. Then the next opportunity for a rate hike is September or then November. So the call at this point in time from the market is there will not be 25 basis point hikes at either September or November heading out into the winter and into 2024. The core PCE rate, which is always typically 1% above, that is where the Fed likes to get, is still 4.6%. And that still means another 25 basis point hike to 5.7-ish, 5.6-ish from where they are now, which is 5.1-ish. So I would not double count the Fed and say that they're wrong like the market's doing. The market has been always trying to buy the rate hike story. That's why it went up. But in this particular context, I would be listening to the Federal Reserve officials and their dot plot. And barring some big news out of the July meetings, I think they'll hike twice at 25 basis points this year to get to 5.7.
So just to dig a little further, does the producer price data suggest inflation cooling enough to give the Fed any reason to ease more on rate hikes?
Well, producer price inflation is a goods intermediate price inflation measure. And the remaining pipeline of service prices that are locked in through long-term yearly contracts like rent is not going to roll over very fast. It has begun to roll over, but it will not roll over fast, and that's 70% of the economy. So that's the issue here. The PPI does not reflect the service sector.
How do you feel about the latest employment data out of the Labor Department?
I think it says, again, what I've always said, we're back down to lower 9-week lows on unemployment claims. There was a little bit of a seasonal pop after the tech layoffs, and the severances played out. That just tells you what has always been the case here. The labor market is super strong, and it's not showing any signs of cooling. And that means, like I said earlier, that does not mean the Fed's going to slow down. And they're going to have to either go perhaps to 6 in the 2024, which also the market will not like to hear.
Do you see then key price measures in a steady decline going forward or not?
I do, Terry. I can't argue with the trends in the price declines. I can only argue that the stubbornness of the core PCE measures, economy-wide measures, which are not the CPI measures, which are just the urban consumers, will be much more static because of the contract effects of rent and shelter. And it will just take a lot longer than the market wants to believe.
The stock market seems to react favorably to this data, this latest batch of data. Have traders just rolled over and accepted that rates are going to be higher longer?
No, they've done the opposite. They're betting on 6+ rate cuts next year from whenever the Fed's terminal rate plays out, which I would assume would be 5.5. Let's say that. So they're looking at a 4% exit in the Fed funds rate at the end of 2024. That's what the market's rallying on, is the discount effect. You discount future cash flow, so when rates are lower later, those are worth more, and that's the basic effect right now. It's not an earnings effect; it's an interest rate discount effect. But frankly, betting on 6 cuts, 6+ cuts, that's all priced in now. So the real issue here is can the market rise when it's already pricing in 6+ cuts next year?
You commented recently in a written commentary that there's a giant discrepancy between leading and coincident economic indicators at the moment. And we now have a signal, the leading to coincident indicator ratio, that typically calls a bottom in recessions and a major turn-up in stocks without a U.S. recession in hand. How reliable is this?
In the last 60 years, pretty good, Terry. 6 of the 8 last recessions would have been called by now, I would point out, though. So if 6 of 8 would have been called by now, then this really is different. And I think it is different because the event we're dealing with is the aftermath of a pandemic on a global level, which we have not seen since 10-ish, 20-ish. And that's World War I area stuff. So that predates the Fed even. So there is no Treasury curve inversion back in those days. There's no Fed. So supply shocks then did raise prices like they do now. That is an understood effect. And that's generally what I would think people are getting wrong here is that, yes, the Fed is hiking to cool demand in the aftermath of the pandemic, but it is not in the data because the Fed did not exist in the previous Spanish flu pandemic.
Against this backdrop, the Q2 earnings season has gotten underway. The big banks kick things off as usual. Now, even though they've passed the Fed's health check, what do you see as the prevailing state of the U.S. banking system?
Well, let's throw in Goldman Sachs' super poor report into the mix because the deal businesses are super stale because of the lack of interest in doing deals right now in the aftermath of higher rates. So we also heard that net interest margins are very high for the banks because they're not paying depositors and they are charging lenders or people who come to them for loans much higher. So it's been a boon for the major banks for now. And that again is, as they have to crank up deposit rates in a more competitive market for those deposits, those net interest margins will decline.
Will shifts in interest rates spark turbulence in that financial sector?
Well, it already has in the regional banks. I'm not telling you anything that people already know. The question is whether it migrates into other sectors like the office real estate market over time. But again, real estate markets are multi-year markets, and leases roll off in really crazy multi-year periods. So it's very hard to call when it all plays out.
Debt-laden firms around the world are having troubles. Do you see that impacting the U.S. multinational companies?
No, I do not. I think cheap debt has refinanced most of their lending at much lower levels in the pandemic period. Any CFO worth his stuff would have refinanced down all the debt.
All right, let's look at some large cap Japanese stocks for a change, namely Panasonic, Nissan Motor, and Komatsu.
Yeah, the Japanese market's had a nice rally this year. I just want to point out, let's talk about it. Panasonic is trading at basically 12 and a quarter. The price target is 14, which is the previous high back in early 2021. And it's rallied from about 8.5 to 12.5 here, which is a nice return for a shareholder. But again, just in this range, it's not nearly out of its range, and it's certainly not a bull market for Panasonic. And it's fascinating because Panasonic really did produce the Tesla batteries, the 4680 in particular, and they sold out of their Tesla shares for the most part, as far as I know. So for whatever reason, there's very little, true fundamental interest in these stocks. It's mainly basically a technical trade off the lows here for Panasonic. Nissan Motor, this is fascinating. Remember in the 90s, Nissan Motor, and this is basically the Datsun business, was a phenomenal stock and a company, and there was no beating it. Even back in 2019, this was an $18 a share stock. It's $9 a share now with a PE of 7. Nobody thinking Nissan Motor is going to go anywhere in the electric vehicle age, but they do. They're going to be 40% electric by 2030. And they did announce they're going to join Tesla's network for superchargers just yesterday. So Nissan Motor, is it worth a trade at $8? It may well be. Again, just from a technical perspective. Komatsu. This stock has been on a big roll this year, like Panasonic, on this momentum trade. But again, it's just the middle of its range, not outside. It's not a bull market in the stock. It's just rising up. But you get a much better story on the earnings here. They are floating up 13% this year and 12% next year. And you had a PE of 11. So amongst the shares that are got both fundamentals and technicals, it's Komatsu you want to look at. That is the tractor business. So think about this as the John Deere of basically Japan. They do have a big export business to the United States, and they do compete with Deere in the United States. So if Deere's going crazy, why not take a look at Komatsu?
Our chief equity strategist and economist John Blank discussing recent macro U.S. economic data. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.